Well, I'm certainly honored, humbled, and honestly a bit intimidated to be giving this address. It's truly a unique opportunity, which creates a bit of a challenge. It's not intended to be a survey nor a full research paper. I suppose the goal, which I'll try my best to achieve, is to keep it simple and yet broad, and at the same time, try to provide some new perspective. Over the past 30 years in my career, we have made tremendous progress in finance. Behavioral finance has come of age. Financial intermediation has moved from backstage to center stage. And we now have access to micro-level data that we would never have dreamt of. Yet the two key questions, how do we price risk, how should firms fund themselves, somewhat stubbornly remain at the heart of the field. Today I'm going to focus on the second question, capital structure. And the key idea that I'd like to convey is that at its heart, capital structure is fundamentally a commitment problem. And that we can understand much of the dynamics of capital structure, its impact on firm valuation, and especially the importance and value of collateral through this lens. In doing so, I'll draw on work with a number of co-authors, including David Beiser, Branko Jurosevic, Anat Admati, Martin Hellwig, and Paul Fleiterer, Jiguo He, Fabrice Torre. And I want to thank all of them for the source of much of my understanding. In fact, the model I will present today will build on this work. In the spirit of acknowledgments, I also want to thank the many other co-authors, colleagues, friends, students that I've had the pleasure of interacting with over the years who have shaped my thinking and helped my research in innumerable ways. I'd also like to thank the support of my family, especially my wife, over the years for all that she has done to support me in my career. With regard to capital structure, we know a lot about what firms should do. Fundamentally, there's a cost-benefit trade-off the firm faces, and we have a good understanding of the key forces that should be first order. On the plus side, there are clear funding cost advantages for debt, specifically tax and information cost advantages. The information insensitivity of debt may enhance its liquidity. And perhaps more broadly, there's growing evidence of potential premia for money-like securities. The idea that very low risk and information insensitive cash flows might receive a better price when sold alone than when combined with risky cash flows. The trade-off, of course, are the increased costs of default and the stress associated with leverage, along with potentially poor investment decisions stemming from underinvestment or risk shifting. Empirically, however, the story is much more complicated. Taxes seem to matter far less than they should, both in terms of the level of leverage the firms choose and in terms of valuation. What's the effect of leverage on firm value? For instance, Korteweg, Van Binsbergen, Graham, and Yang document that the net benefit may be just a few percent. There's also large unexplained variation in capital structure, both across similar firms within industries, where, for example, Lemon, Roberts, and Zender document a persistent firm fixed effect, and even within the same firm, we see significant variation in leverage over time. Strebolev and Yang show many firms have low or zero leverage, which is hard to square with existing theory, and firms that do use leverage seem to adjust it only very slowly, if at all, towards a target. Welch documents that much variation in market leverage is passive. Baker and Wergler show significant path dependence of capital structure even after a decade. Finally, there's the well-documented negative relation between profitability and leverage, which seems to strike directly at the heart of tax-based motivations. Now, in contrast to these negative results, one clear positive result which stands out in the data is related to collateral, which appears to be a dominant force in leverage decisions, especially if we account for leases, as emphasized by Eisfeld, Rampini, and Vishwanathan. Collateral also impacts debt maturity choice, as shown by Ben Mellick and others, and it affects the timing of debt issues. Ekbo, Kisser, and others have shown that issuance is frequently coincident with capital investment. My goal today is to outline a relatively simple dynamic model of capital structure that can explain the dominance of collateral in firm funding choices, together with the other empirical regularities noted here. I'll do so by taking our standard neoclassical model of the firm and highlighting what I believe is a key friction, the non-exclusivity of standard contracts, and embedding it in a dynamic agency framework. So why is collateral important? The conventional view of collateral, which describes the majority of our existing models, assumes that the main friction is the non-pledgeability of cash flows, or the non-enforceability of contracts. In particular, if it's costly to verify resources, if it's too easy to abscond with funds, or if assets are non-transferable, such as human capital, then in such an environment, raising external capital via unsecured debt or equity is impossible. As a result, secured debt is the only available contract, and thus, not surprisingly, collateral matters. It resolves the friction between borrowers and creditors. But in reality, collateral matters even when pledgeability and enforceability are high. The large firms that we study empirically have easy access to both unsecured borrowing and equity financing. And yet collateralized borrowing still retains a prominent role. For financial intermediaries alone, the volume of collateralized borrowing is in the multiple trillions of dollars. Moreover, collateral appears to be highly valued, with assets that may serve as collateral commanding a premium. Why does collateral retain such importance even when pledgeability is not a problem? After all, in default, creditors own the entire firm, not just specific assets. And so why should the right to specific assets be more important than the right to aggregate cash flows generated by those assets? Here I'll focus on a different view of collateral, one that is most important when pledgeability is high. In this view, the fundamental friction is non-exclusivity, which is simply the idea that the firm may raise funds from multiple investors, and specifically multiple creditors over time. In that case, collateral is most valuable not to resolve a friction between the firm and an investor, but to limit competition between potential creditors. This friction in the context of corporate debt has been examined in a number of papers and is clearly articulated in outstanding recent work by Donaldson, Grom, and Piacentino, who contrasted specifically with pledgeability. Here, the key problem with unsecured debt is that it remains vulnerable to dilution, both direct dilution of claims in bankruptcy, but perhaps even more importantly, its vulnerability to indirect dilution, which follows from the fact that total leverage affects the borrower's future investment and default decisions. Moreover, as noted by Donaldson et al. And Myers and Rajan, these dilution concerns are more severe when it's easier for the borrower to pledge or to sell assets. Secured debt, on the other hand, resolves the non-exclusivity problem. How? In contract law, there's the concept of the perfection of a security interest, which allows a creditor to establish a claim against the borrower to the exclusion of other creditors, essentially ring-fencing assets from claims by others and thereby establishing superseniority of the claim. Crucially, once the firm uses an asset as collateral in one transaction, it cannot reuse the same asset in another, thus resolving non-exclusivity. My goal here is to integrate this perspective from the contracting literature into a dynamic trade-off theory setting. So how does non-exclusivity impact the fundamental trade-off for the firm's choice of leverage? On the one hand, the funding cost advantages from debt issuance are largely captured by the borrowing creditor within the terms of the transaction. But in contrast, the costs of excessive leverage are largely shared by all creditors. Not surprisingly, this externality will significantly distort the economics of individual trades. In particular, the non-exclusivity of unsecured debt will lead to the dissipation of the gains from trade we normally attribute to leverage. And therefore, collateral may be a necessary ingredient for the firm to actually capture the funding cost benefits of debt. What I'll do next is formalize this idea by demonstrating that this friction alone can account for a number of the empirical regularities discussed earlier and lead to a central role for collateral. Then we'll come back and consider other potential solutions to this problem that arise in practice. So consider a firm with existing capital or collateral KT, which depreciates over time. The productivity of that capital is subject to persistent shocks, so that cash flows accrue at some rate YT, which follows a log normal diffusion. Now suppose new investment opportunities arise stochastically at some rate lambda over time. For example, the firm might open a new location or launch a new product. I indicate investment by the orange spikes you see in the figure. Making investment boosts the firm's cash flows by some factor theta, and a fraction alpha of the new investment is in the form of tangible capital that adds to the firm's available collateral KT. Given these basic dynamics of the firm's investment, earnings, and capital, how will the firm optimally choose to finance itself? Well, let's make the following assumptions. First, suppose there's some funding advantage to debt. This could be, as usual, the debt tax shield, with the firm paying only the after-tax coupon on its debt. I'll also allow for the possibility of a moneyness premium. Again, the idea that low-risk securities may trade for a premium, perhaps as a result of improved liquidity or due to market segmentation or market timing. As a result, the firm may face a lower cost of capital in debt markets by some factor eta. The trade-off is a cost of default in terms of some loss of cash flow, but this loss could be small. The firm can issue equity, unsecured debt backed by a fraction beta of its cash flows, or secured debt backed by its available collateral. The firm acts to maximize its share price at all times, both in terms of investment and issuance decisions. And note in particular that this means the firm does not commit upfront to its future decisions, but instead is optimizing ex post. There are no other exogenous frictions in the model, no transactions costs, no issuance restrictions, etc. In other words, this is a standard trade-off theory model in a dynamic agency setting in which the firm optimally adjusts its capital structure at each point in time. Here I've plotted an example showing the unlevered value of the firm and the value of the firm's collateral. So what will be the equilibrium level of leverage in this example? Before I tell you the answer, let's consider three distinct policies. In the first policy, the firm only issues secured debt backed by its available collateral. In the second policy, the firm also issues unsecured debt, increasing its borrowing gradually over time when profits improve. In the third policy, the firm again issues secured and unsecured debt, but this time borrows much more aggressively against its cash flows. I'll tell you more about these three policies later, but first let's consider their qualitative features. Only policy 3 fits the usual view of trade-off theory, with the firm appearing to fairly actively adjust its leverage toward a target. Policy 2 shows some slow adjustment, but profitability moves much more quickly, and thus leverage will tend to fall as profitability rises, and vice versa. Policy 1, of course, shows no adjustment based on profitability. Finally, note that the only feature these three policies share empirically is the impact of leverage on collateral. The impact of collateral on leverage. As you can see, in each case, leverage jumps with new investment. Okay, so which is the equilibrium outcome? Hopefully you've had a chance to pick your favorite. The answer is that all three of these are equilibrium policies. Moreover, they will all lead to the same initial share price for the firm. Even though policy number 3 entails much more borrowing than policy number 1, there will be no valuation gain for the firm. In other words, the firm is only able to capture a funding advantage for its collateralized borrowing. The additional borrowing of policy number 2 or number 3 provide no direct gain. Okay? They're equilibrium policies. In fact, all three are equilibrium policies. But no distinction in valuation, all for the same parameters for the firm. Now that you know the result, let me try to provide some intuition for it. Consider the simplest possible trade-off model. Suppose cash flows decline deterministically and the firm issues perpetual debt. Then the firm will default once its cash flows fall below required debt payments. And if all remaining cash flows are lost in default, make a simple assumption, then the firm trades off the upfront gains of borrowing versus losses in default. Starting with no or low leverage, of course, the initial gains outweigh the costs, and increasing leverage adds value relative to an all-equity firm. And this continues until, at an intermediate level of leverage, firm value reaches a peak and then starts to decline as leverage becomes excessive, giving us the usual hump shape for firm value as a function of leverage. Okay, so let's set leverage back to the static optimum level here. And now suppose that after some time has elapsed, the firm has an opportunity to rebalance its debt. How would it choose to do so? From an ex-ante perspective, because the cash flows have declined, it would be optimal to commit to reduce its debt and adjust leverage back to the optimal level. This hypothesis that firms rebalance to the optimal target leverage underlies the standard predictions of trade-off theory. But of course, with full commitment, we could do even better than this. The firm could wait and then repeatedly reduce debt in a way that avoids default altogether. That would become riskless, and in the limit, the first best could be attained with 100% debt financing. In other words, with full commitment, the trade-off of trade-off theory disappears. In this deterministic setting, this commitment would be simple to implement by choosing the debt maturity to match that of the cash flows. Now suppose the firm does not commit to a policy ex ante. When faced with the opportunity to rebalance, what will it choose ex post? In this case, from shareholders' perspective, the existing debt payments are sunk. And so, just as they did initially, shareholders will find it attractive to borrow against the remaining residual cash flows. Thus, to maximize its share price, the firm will choose to issue more debt ex post. In other words, rather than rebalance to the optimum, the firm will choose to ratchet up leverage even further. This leverage ratchet effect, which I explore in my paper with Anat, Martin, and Paul, is quite general, and it implies that leverage choices are essentially irreversible. As you might anticipate, this irreversibility will impact the debt price, and, as with any real option, potentially slow the firm's leverage adjustment. Let's see how this plays out in equilibrium as we increase the frequency of leverage adjustment. Shown here is the equilibrium if the firm can choose leverage only once. Now suppose it can reoptimize every 10 years, then every 5 years, every 1 year, monthly, weekly. Note the key features that emerge as we increase the frequency of trade. The firm issues new debt at each opportunity, leading to higher ultimate debt. But because the debt price anticipates this future issuance, its initial yield is higher, and so the firm's initial demand for debt is reduced. Finally, note that in the limit with frequent trade, the debt adjustment is a smooth policy. Now, in this example, with perpetual debt, the debt level is always increasing because the debt is permanent. In reality, debt levels decline when debt matures. Let's repeat the same analysis with amortizing debt. For example, suppose 5% of the debt matures each year, as shown in the static equilibrium here. As we increase the frequency of trade, again, we see the same convergence to a smooth adjustment policy. As before, the debt level gradually increases at first, but now ultimately falls when leverage becomes very high, and the rate of new issuance is below the rate at which debt matures. The same analysis can be extended to a continuous time setting with stochastic cash flows and asset growth, as developed in my work with Jiguo He and also Jiguo and Fabrice Torre. In that case, we see the same smooth adjustment process, with leverage trending to a target at which new issuance balances maturity and growth. How does this pattern of issuance impact valuation? In the static model, valuation increases as we shorten the maturity of debt. And in the deterministic case, we can even achieve the first best when the debt maturity matches that of the cash flows. But as we increase the frequency of trade, the share price falls and ultimately collapses to the value of the unlevered firm. The tax and liquidity benefits of debt are fully dissipated. The only case for which this does not happen is if the debt matures fast enough that the debt is risk-free. But this is only true in our simple deterministic example without any noise. Once the cash flows are risky, the same result holds no matter how short we make the maturity of debt. In other words, short maturity does not resolve the commitment problem, and we get the full dissipation of the gains from trade. Let me try to provide some intuition for the analytics behind this result. To do so, it's useful to think in terms of a monopolist problem, the firm selling debt to its investors. In this context, we'll see that the results regarding the share price is closely related to the Coase conjecture from durable goods monopoly. The demand curve is the price investors will pay for the debt, given the total face value of debt outstanding. It's equal to the present value of the expected coupons investors will receive. and it naturally declines with leverage as default risk increases. The firm's marginal cost for debt is below this price, as shareholders discount the after-tax coupons at a higher rate that does not include the liquidity premium enjoyed by debt. In an MM world, these two curves would coincide and there'd be no incentive to issue. But with tax shields or a moneyness premium for debt, which lowers the cost of capital, there is a gap and thus gains from trade. Of course, the optimal issuance in the monopoly problem is to set marginal cost equal to marginal revenue. So let's add the marginal revenue curve. And so profits are maximized by issuing an amount delta that is equal to the difference between price and marginal cost divided by the marginal price impact. Of course, once the monopolist has issued this amount, there's a temptation to satisfy the residual demand and issue more, which is simply the leverage ratchet effect we described earlier. Okay, so what happens as we increase the frequency of trade? For a short time interval, the difference between price and marginal cost is simply the tax savings and liquidity premium that will accrue before the next opportunity to trade. So when the trading frequency increases, this gap is of order dt. So as long as the price sensitivity of debt is positive, the optimal issuance is also of order dt. That is, the limit issuance policy is a smooth trading policy. What about the gain from trade? As you can see, the gain is proportional to delta squared. Right? This is equal to the issuance amount delta times the gap between price and marginal revenue. This gain, proportional to delta squared, is therefore of order dt squared. Thus, the cumulative gain from trade collapses to zero as the trade interval shrinks. Again, this result is analogous to the Coase conjecture from durable goods monopoly. By competing with itself, the monopolist dissipates its monopoly rents. The key takeaways, again, which build on my work with Gigo and Fabrice, are first that with continuous trade, the firm will issue debt gradually at a rate that balances the funding cost advantages of debt with its price sensitivity. As a result, leverage adjusts slowly over time, with new issuance offset by debt maturity and asset growth, and the speed of adjustment towards the target dependent on the debt maturity. And finally, as a result of non-exclusivity, the potential gains from trade due to the funding advantages of debt are fully dissipated through an increase in default costs and investment distortions. Okay, so with that background, now let's add collateral to this setting. Here again is the model with collateral introduced earlier. Recall that the firm has aggregate capital KT, which depreciates over time and increases with new investment opportunities, fraction alpha of each new investment corresponding to tangible collateral. The firm generates aggregate cash flow based on its past investments and their current profitability. And again, the question is, what's the optimal capital structure, and how does it relate to the firm's cash flow and collateral? Consider first a setting in which collateral is not available and the firm can use only unsecured debt. In that case, the firm's optimal borrowing will depend only on the firm's cash flow. In particular, it will not issue debt to fund new investment, though it will borrow against the future cash flow generated by that investment. The intuition is that due to the firm's ability to borrow repeatedly, investors will demand a high credit spread initially, to the point that there's no funding advantage at the margin. And thus, there's a funding disadvantage due to price impact if it issues a large block of debt at once. Instead, the firm will increase its borrowing gradually as the post-investment cash flows accrue. Here's an example of an equilibrium capital structure with unsecured debt only. As you can see, leverage responds only slowly to the firm's profitability. In particular, note, for example, here that there's no immediate response of leverage to new investment, again indicated by those spikes in the graph. Now suppose the firm's investment does include collateralizable assets, such as real property, equipment, inventory, or receivables. These assets have market values which are relatively predictable. By using such assets as collateral, the firm can guarantee creditors a minimum recovery value. Moreover, this guarantee is not diluted by future debt issuance. Current creditors have exclusive rights to this collateral. Given this guarantee, the value of secured debt becomes independent and ultimately insensitive to total leverage. Looking back at our formula for optimal issuance, because the price sensitivity of secured debt drops to zero, the optimal issuance remains discrete even as the time interval becomes continuous. In other words, it's optimal to issue secured debt in discrete blocks. And in that event, the firm will capture a discrete gain from the trade. Thus, when the firm can issue both secured and unsecured debt, with each new investment opportunity, it will be strictly optimal for the firm to finance new collateral using secured debt. By doing so, the firm is able to capture the full funding advantage associated with its secured debt, and this lowers the firm's effective cost of capital, potentially leading to additional investment. Again, unsecured debt is not immediately affected by investment, but will respond gradually to the firm's future cash flows. Going back to our example, now we see the rationale behind the three policies we discussed at the start. In each case, note that secured debt increases immediately when the firm invests in new collateral. In policies 2 and 3, the firm also issues unsecured debt. This debt evolves gradually in response to the firm's cash flows. In policy 3, the firm is using short-term unsecured debt and therefore adjusts its leverage more rapidly. Under policy 2, it uses long-term unsecured debt and adjusts it more slowly. But in either case, the opportunity to issue unsecured debt does not increase firm value, as the funding advantages are fully dissipated. Thus, policy 1 shows another possibility. Because there's no funding advantage from unsecured debt, the firm chooses only to issue secured debt. This policy is also optimal from shareholders' perspective. Again, note that in all three cases, debt and collateral are closely correlated, whereas debt and profitability need not be, especially in the short run. In terms of valuation, the central result is that a marginal dollar of unsecured debt does not change the value of equity. On the margin, we obtain a Modigliani-Miller type of value irrelevance, even in the presence of large tax or moneyness advantages to debt. On the other hand, equity holders do gain when the firm issues secured debt, as the firm is able to capture its full funding advantage. It's therefore optimal for the firm to issue collateralized debt whenever possible. So as promised, I've presented a model in which there's a funding advantage to debt and no restrictions on issuance. In the model, as in the data, collateral is a primary determinant of leverage and firm valuation. But the broader takeaway message that goes beyond this specific model is that all capital structure tests suffer from a joint hypothesis problem. In particular, they combine a capital structure theory regarding the primary drivers of leverage, such as tax benefits and distress costs, or information asymmetries, with some imperfect commitment technology. Imperfect because we know with perfect commitment we could avoid default altogether and use up to 100% debt financing, which is not what we observe in practice. Collateral is one natural and low-cost solution to the non-exclusivity problem. For this reason, collateral will have value and will be scarce, encouraging its optimization and even its reuse. That is, collateralized debt may itself serve as collateral in other transactions. That said, there may sometimes be trade-offs in the use of collateral as well, and in any case, once a firm has exhausted its collateral, it may seek other commitment mechanisms. Other commitment mechanisms we observe include, for example, seniority provisions. These help to reduce but do not eliminate the non-exclusivity problem, remaining vulnerable to asset sales, future security interests, maturity rat races. Restrictive covenants, which limit the amount and timing of future debt issuance, are also valuable, but of course reduce the firm's operational and financial flexibility. Relationship banking can be viewed as a commitment mechanism. By committing to the same lender, the firm mitigates the non-exclusivity problem, but suffers from reduced competition between creditors. And reputation building can be important. For example, a commitment to maintain a certain credit rating could be quite valuable. Private equity firms can also maintain a funding advantage based on their reputation for handling leverage, as emphasized in recent work by Malenko and Malenko. But again, reputations may be slow to establish and can be fragile ex post. Finally, external frictions that impede debt issuance, such as regulation or transactions costs, may also play a positive commitment role. But as we think about these other mechanisms, one thing that remains clear is that path dependence is inevitable. In particular, empirically, context will matter. Firms will choose an ex-ante optimal commitment mechanism based on some initial context, but then will suffer from ex post rigidities that appear suboptimal in the future. And in our theoretical work, we need to be explicit about the commitment mechanisms that underlie our results. which are often embedded in assumptions we may make for tractability, such as one-period debt or risk-free debt, one class of debt, refinance requirements, transactions costs, etc. Yet these will all have a first-order impact on our results and on our predictions due to the commitment role that they may play. Let me conclude with a simple example in the context of the regulation of financial intermediaries that I hope will highlight the power of rethinking capital structure from this perspective of commitment. We care a lot about bank leverage for a variety of reasons: default externalities, the impact of debt overhang on lending activity, broader asset pricing consequences in the emerging literature on intermediary asset pricing. As a result, leverage is regulated, often by imposing strict limits on the amount of debt banks can issue. But this regulation itself provides a commitment technology for banks. To see its effect, consider our simple trade-off model from before, where I've shown the optimal one-shot issuance together with the equilibrium with frequent trade. And now suppose we introduce a constraint capping leverage here at a level that does not bind relative to our previous equilibrium. What's the effect? We might expect that introducing a non-binding constraint would have no effect on equilibrium. But on the contrary, the previous equilibrium disappears, and the firm will borrow up to the cap immediately. Why is this? Well, the cap provides an automatic commitment technology, and this commitment is valuable. Now, even though the constraint binds, that does not mean the firm would be better off if the constraint were relaxed. In fact, in this example, both ex-ante welfare and share prices would increase if the leverage constraint were tightened rather than relaxed. Unfortunately, ex post, once banks are already at the constraint, share prices will be negatively impacted by any tightening, and we should expect banks to lobby actively against them. If such lobbying is influential, we may also suffer from an effective irreversibility in policy. Once the cap is set too high, it's too difficult to reduce it. Okay, with that, let me wrap up. As I've argued today, a key friction in the context of dynamic capital structure is non-exclusivity. Collateral provides commitment, which is crucial to capture the funding advantages of debt. More broadly, this perspective highlights that leverage is not just a quantity, and our efforts to understand it as such were doomed to fail. Leverage is instead a path within a rich context of past commitments and current conditions. The need for commitment implies that we should expect to find ex post rigidities and suboptimality. Contracting completeness and commitment mechanisms must be first order in understanding leverage dynamics. As with perfect commitment, there is no trade-off. And as a result, our theory and tests need to be much more explicit. We need to highlight both the key frictions that motivate leverage together with available commitment technology and its potential trade-offs. Finally, I believe that as we refine our understanding of this rich texture of capital structure, there will be important spillovers to asset pricing, both in the context of the firm, such as recent work on maturity risk premia by Chandarina, Weiss, and Zechner, and more broadly in the context of the new class of intermediary-based asset pricing models, where leverage and collateral play a dominant role. Thank you again for this tremendous honor and great opportunity. Thanks.
Peter, thank you very much for your service to the AFA. And in honor of that service, we want to make it impossible for you to carry your luggage on your return flight. We have two things for you. The first is a plaque recognizing your service as AFA president.
Thank you.
And the second is the outgoing president of the AFA becomes an AFA fellow. So Peter, you are now an AFA fellow.
Thanks very much, Dan. Thank you.